You've been in a raid before, a boss too big to solo, so you team up. A party of players, each bringing what they've got, led by someone who actually knows the fight. A mutual fund is that exact same thing, except the boss is the stock market and the loot is money. Here's the problem it solves. Investing in a single company is like soloing a raid boss. If you read the fight perfectly, the loot is incredible. But one mistake, one bad quarter, one scandal, one product that flops and you wipe. Your whole run gone. Most people don't have the time, the skill, or the gold to solo the market, so they don't. Instead, they do what every smart player does when the content is too hard. They join a party. A mutual fund pools the gold of thousands of players into one giant shared stash. That stash doesn't buy one company. It buys hundreds. And it hands the controls to a raid leader, a professional fund manager whose entire job is to run the content for the group. When you put money into a mutual fund, you are not buying a stock. You are buying a share of the party's loot pool. If the fund holds 200 companies, you own a tiny slice of all 200. The price of your share, the fund's net asset value, is just the whole stash's worth, divided by everyone's shares. The party wins loot, your share goes up. The party takes damage, it goes down. You rise and fall with the group. And this is the first superpower, diversification. In a raid, you do not fill your party with 5 glass cannon damage dealers. One bad pull and everyone is dead. You bring a tank, a healer, damage, support. A balanced comp, so no single death wipes the run. A mutual fund does the same thing with companies. If one holding blows up, the other 199 carry the team. And it doesn't stop at company. The best parties spread across zones, too. Different industries, different countries, so one region wiping never ends your run. You trade the chance of a legendary solo jackpot for the safety of never getting one shot. But here's something most people miss. Not every raid is the same content. A stock fund is the high-end raid, the biggest loot, but real danger. A bond fund is the steady dungeon grind, smaller, safer drops that show up like clockwork. A target date fund is the smartest of all, content that auto-scales its own difficulty, loaded with risky raids while you are young, quietly dialing down to safe dungeons as you approach your level cap, retirement. And a money market fund is the safe zone bank. Almost no risk, almost no loot, just a place to park your gold. And how you split your party depends on your level. When you are young, with decades of raids ahead, you load up on high-risk, high-loot stock funds. You can afford a wipe or two because you have time to recover. But as you near your level cap, the goal you are saving for, you shift toward the steady bond dungeons, protecting the loot you have already earned. Aggressive early, defensive late. That single shift is the heart of almost every smart investing plan. So who is actually playing? The fund manager. They are the carry. While you are offline living your life, they are in the raid every single day, picking companies, rebalancing the party, deciding what to buy and what to cut. You are paying them to play your account for you, and that is where it gets interesting. Because the raid leader does not work for free. Every single year the fund skims a cut of the entire stash. It is called the expense ratio. Maybe it is 0.5%. Maybe it is a full 1 or 2%. It sounds tiny. But here is the part nobody feels. They take that cut whether the run goes well or not. Win the raid, they take their cut. Wipe the raid, they still take their cut. It comes out of the loot pool automatically every year forever. And that tiny number is not tiny. Let me show you. Say you put $10,000 into a fund and leave it for 30 years, earning about 7% a year. With a cheap fund, you end up with around $75,000. With a fund charging 1% a year, that same run leaves you closer to $57,000. That 1%, the cut you barely noticed, quietly ate almost $18,000. Nearly a quarter of everything you earned gone. Not to the market, not to a crash, to the cut. Now the whole game splits into 2 play styles. The first is the tryhard carry. This is an actively managed fund. A manager who micromanages every pull, trying to outplay the market and beat everyone else. They charge a premium fee for the privilege because they are convinced their skill is worth it. The second play style is the auto farm. This is an index fund. There is no hero making big plays. It just quietly buys the entire board, say, the 500 biggest companies and holds. No micro, no genius, set it and walk away. And because nobody is grinding, the fee is almost nothing. This idea used to be heresy. Back in 1976, a player named Jack Bogle did something the entire industry mocked. He said, stop trying to be the hero. Stop paying a fortune for a carry who probably loses. Just buy the whole board, every big company at once, and never sell. They laughed at him. They called it un-American, settling for average. He built a company called Vanguard and launched the first index fund anyway. Today, that boring auto farm strategy manages trillions, and it is one of the most popular ways on earth to invest. So here is the question the entire industry is built on. Over 10 or 20 years, does the tryhard carry, with all their skill and all their fees, actually beat the brain-dead auto farm? You would assume yes. The pro who plays every day should crush the player who is away from the keyboard. The data says the opposite. Study after study finds that over 15 years, around 9 out of 10 actively managed funds fail to beat their simple index. 9 out of 10. The auto farm wins. Why? 2 reasons. The market is incredibly hard to outplay consistently. The other players are smart, fast, and everywhere, and they all have the same information you do. And the fee. That 1 or 2% skimmed every year, win or lose, compounds into a monster. The tryhard isn't just fighting the market. They are fighting their own cut every single run. Picture 2 players. Same gold, same 30 years, same market. One hires the expensive tryhard carry. The other just runs the cheap auto farm and logs off. They take the same hits. They ride the same crashes. They win the same fights. But every single year, the first player's carry quietly skims a little more off the top. 3 decades later, they finish the exact same raid, and the player who went away from the keyboard walks away with tens of thousands more. Not because they were smarter, because they kept more of their own loot. And it gets worse. Some of those tryhard carries are not even really playing. They are closet indexers. A manager who secretly just hugs the board, holding almost the same companies as the cheap index, barely making a move while still charging you the full premium carry fee. You are paying hero prices for a player who is quietly away from the keyboard. So if you ever do pay for an active fund, make sure your carry is actually carrying. You will also hear about a close cousin, the ETF. Think of it as the same party with one upgrade. Instead of cashing out your share only once a day after the market closes, you can trade it instantly any second the market is open. For most players, it barely matters. Same idea, same diversification, often the same tiny fee. Just a more convenient way to hold the exact same loot. There are a few more rules on the board. Some funds charge a load. A cover charge just to join the party, taken straight off the top before you have earned a single coin. Avoid those and watch out for one more cut, the taxman. In a normal account, when the fund sells its winners, you can owe tax on those gains, even in a year you never touched a thing. The fix is to do your rating inside a tax-advantaged account, the retirement accounts built for exactly this. Think of them as a special dungeon where your loot grows untaxed for decades. Same funds, same strategy, but the taxman waits at the door instead of skimming every run. And before you ever join a party, check one number. The expense ratio. Under about 0.2%, and you are looking at a cheap auto farm. Over 1%, and you are paying hero prices for a carry who probably will not deliver. That one number tells you almost everything about whether a fund is worth your gold. And the smartest way to play is not to dump everything in at once and pray. It is to grind. A fixed amount every single paycheck automatically. Buy when the market is up, buy when it is down, and let the average work for you. The boring grind beats the big risky push almost every time. Now, one warning the brochure buries in the fine print. Diversification protects you from one company dying. It does not protect you from the whole server going down. Every so often, the entire market wipes at once. A recession, a crash, a year where everything you own bleeds red. And here is the brutal part. That is not the dangerous moment. The dangerous moment is what you do next. When the party looks dead and every instinct is screaming at you to log off and sell. The players who lose are the ones who rage quit at the bottom, turning a temporary wipe into a permanent loss. The players who win do something that feels insane. Nothing. They hold. They keep grinding. Because the market has wiped many times before, and every single time, eventually, it has respawned. And then there is the real secret weapon, the one that does all the heavy lifting. Time. Gold left in the raid doesn't just sit there. It compounds. Your loot starts earning loot, and that new loot earns more, like idle experience snowballing while you are offline. In year 1, it is barely noticeable. By year 30, it is the entire game. The longest-running parties don't win because they played the best. They win because they never logged off. So strip it all away, and a mutual fund is simple. You do not have to be the hero. You do not have to solo the boss. And starting is easier than it sounds. Open an account with any major broker. Buy one broad, low-cost index fund that holds the whole market. Set it to buy automatically a little every paycheck. And then the hardest move of all, leave it alone. Let it farm while you live your life. Just remember the one rule the raid leader hopes you forget. The carry takes their cut whether you win or lose. So pick the cheapest party that still gets the job done, and then give it time. Because in this raid, the player who pays the least and waits the longest almost always walks away with the most loot.